welcome to the weekend webinar. Oscar Carboni and Short-Term Trading Live with Oscar's weekend webinar. Traders, as you know, in these weekend webinars, I like to cover markets. I like to read all the news. I like to take long-term views of where we're going and, of course, short-term views. And then I like to disseminate all of that and bring it to you. This video, before we get going, is being filmed on the weekend on Saturday for trading Sunday through Monday, February 6, 2012. Traders, we all know that futures trading is extremely risky, can cause substantial financial loss, and is not suitable for every trading account. If you do not recognize that a stop is your best friend, and you do not have risk capital to lose, you probably shouldn't be playing these commodity markets because they're rough and tumble. For you traders out there that understand the risks behind this game and recognize that a chart will always tell you where a market's going to go before fundamental news, that is what this weekend webinar is about, traders. It is about the charts telling us that the fundamental news would be bullish, and of course, the streets themselves telling us that the charts would be bullish and the news would be bullish. And here's what I'm getting at. Traders, as you know, I love to read the newspapers, and over this weekend I read my share, a nice stack, and I have some news. The unemployment rate dropped again this month for the 5th straight time in a row. Go unemployment. And it's down to 8.3%. Now, you may argue with the figures, but these are the figures that the U.S. government releases. True, not true, who knows? These are the figures that we have to trade, so do not argue the figures. Do not fight the Fed. Use the charts to see where we're going next. So unemployment rate drops for the 5th straight month in a row, and it is down to 8.3%. Do you realize, I said it's down to 8.3% according to the figures. Do you realize that unemployment was standing at 4.9% before the recession started? 4.9%, here's where we were. The big recession starts, goes down to 10%, or up, I should say, to 10%. Since then, 4.9% is where we started while we were in good times. We're down to 8.3. That means another 3.4% of people getting employed, and we are back to where we were before the big crash in 2008 and 9. Traders, I've been telling you in these videos for weeks now that the charts are telling us that we are going to recover in our economy, and I've been coming in front of you and putting the charts up and telling you, look, they are getting more and more long-term bullish every day. In fact, when we're done with this video, I think you will totally get why we are now turning more bullish. I've been telling you this, and here is the proof. Who remembers the video series about Las Vegas being the great barometer of economic activity?
I do.
You remember that video?
I do.
Do you traders remember that video? I got a lot of heat from it because I remember the video. I came out and studied and filmed all around Vegas with my crew and came back to tell you something amazing was going on. That for some reason, there's a lot more activity in Vegas than I have seen in the last 3 years since the recession started. I'm noticing real estate starting to pick up, and we went out with our cameras and started speaking to people, traders. 90% of the people that we met were Americans from all over the United States. They were not foreigners. And I'll tell you right now, if Americans from all over the U.S. come to Vegas, they are coming because they're doing better, and the people who come here represent all 50 of our states. Now, you may say, oh, of course, Oscar, during times of recession and during bad times, people resort to tobacco and gambling and booze, but they don't have money to fly to Vegas, get a hotel room, drop money gambling, and enjoy themselves. That they don't have if they're wallowing in their sorrows drinking. So that is not why Vegas is a barometer. Vegas is a barometer because it shows a sampling across the United States. So if you remember that video, traders, who remembers the video series back in November about real estate in Las Vegas picking up? And I got a lot of heat about those videos too. You guys told me I was crazy. I sent out my crew. They showed construction happening all over Vegas, and I said to you, if it's happening here, one of the worst hit states, in fact, the worst hit state in the nation in terms of hardest hit foreclosures. The most foreclosures that we've had across the country happened in Vegas or Nevada, right? If this state got hit the worst, and I'm noticing economic activity picking up and real estate picking up. It's a cinch that if job growth is growing here in Vegas or in Nevada and Vegas, and if real estate's getting better, and overall there are more visitors, then the whole nation is doing better. The name of that video series, traders, was Where is the Recession? And I got a lot of heat, but that was only a couple of months ago. Look at the economic numbers we're starting to get now. The charts weren't wrong. The streets were not wrong. Now that the official figures regarding the economy's health and real estate situation have proved my Vegas barometer to be correct, I've got headlines. Traders, the Wall Street Journal, Saturday, February 4th, 2012. Headline, developments get back to the plan. On Tuesday, bulldozers began rumbling to start and launch the construction of Great Lakes Parks neighborhoods, a 2,000-acre planned community in Irvine, California. It's one of the many large projects that are underway across this nation. Great Lakes is a $1.4 billion project with 10,700 homes planned. Great Parks has been on hold since the recession began. It is now back on track. These bigger master plan communities are the key to real estate in the United States recovering, because these big projects, not people building a home down the street, not even 10 homes, these big thousands and thousands of home projects, they require large amounts of capital to pay for roads, to pay for sewer systems, to pay for golf courses, and of course to pay for workers. And that is not all, traders. The good news about real estate continues. In Arlington, Texas, Viridian Builders has just started a 5,100 home community on the site of a condemned rock quarry outside of Dallas. There's more. In Florida, that's right, Florida. Hey, are you listening? Scoop, you know who I'm talking to. In Florida, one of the hardest hit markets in the nation, a group of investors has begun a 6,700 home project outside of Tampa. I told you that Vegas was a barometer of economic activity. I told you the charts were pointing towards the markets moving higher. And I told you on Friday, stay long through the employment report, because the charts want us long and we would go higher. And the markets did go higher. Traders, that is a pretty good barometer, but now it's beginning to happen. The analysis is pointing towards it. The market itself is getting stronger. The outside money's starting to come in slowly. Big IPOs are starting to hit the books and hit the street. You have Europe now using our Fed's bond facility to get themselves stabilized. Europe was supposed to be 3 to 6 months behind us in our recovery. Look at your charts. They are, traders. That is what's going on now. They're starting to slowly get their house in order, and they will follow the U.S. higher. There's an old adage. When the U.S. sneezes, the rest of the world catches cold. Well, that adage works backwards as well, traders. When the U.S. is in an upswing, many other countries get wind under their sails or feel tailwind from it, because it's the opposite of when the U.S. sneezes, right? If the rest of the countries feel it when we sneeze, they feel it when we recover, and we are absolutely in a recovery. Now, I want you to understand another thing that's going to happen, and I am not political by any means, and I don't care who gets in the White House. Traders, Republican, Democrat, Ron Paul, I don't care if you put Jennifer Lopez in the White House and let her dance for us. I'm a trader, and all I know is it creates volatility. I think that Barack Obama, and I am not politically motivated by any means, is going to win the election in a few months. Do you know why? Look at the economy right now and look at the figures that have come out. He's going to stand there and say, listen, when those Republicans had control, the country almost went bankrupt. All the banks went down. We lost Lehman. We lost Bear. We almost went bankrupt. We were in a worldwide depression when the Republicans had office. Since then, traders, I'm a Democrat, right? The market's doing better. Real estate's starting to turn. Employment is coming down, or I should say unemployment's coming down, employment's going up. And he's going to walk into the White House, I think, on that. So this is a very interesting year. Again, I don't care. We're traders. We'll take the volatility. With no further ado, let's go look at some charts. Okay, traders, the first chart we are going to look at this evening is the copper daily bar chart. The copper daily bar chart with the 200 bar moving average overlaid. Traders, you'll recognize that when copper gets under the 200 bar, it takes a bath, right? A big bath. When it gets over, it is strong. Did you know that copper is an excellent barometer of economic activity? It is an economic indicator. Copper absolutely is a barometer of economic activity. And as you can see, we are now besting the 200 bar moving average in copper on the daily. We failed last time and it was a miserable break, but we're besting it now. Look at the copper on a weekly, traders. Weekly copper, each one of these bars now represents 1 full week's worth of trading. As you can see, when you get under the 200 on a weekly, it gets ugly. You get back above it, it's a nice run. We've come down to it, tested it, held, and we are back up. Traders, the economic indicator is pointing up just like the economy is, just like our charts in the indices are. Let's continue to look around. You're going to love these charts tonight. E-mini S&P. This is a weekly bar chart. Each one of these lines represents 1 week's worth of trading in the E-mini S&P. This is a wonderful parallel channel that we've been in since the crash lows of 2009 when we hit 666 of the S&P. That's been the low. We are in a wonderful parallel channel. Better than that, traders. This is one of our OMNI proprietary averages. Look at how the respect gets paid by the E-mini S&P to this average. Can't get under it, can't get under it, finally does. Goes back, hits it once, big, big bath. When it finally gets above, big, big major rally, touches it, major rally ensues. This time it gets under it thanks to all the monster news that we had to deal with in the last 2 months. But look at the breakout since it's gotten above. It looks fantastic right now, poised to take out previous highs. You gotta love the weekly E-mini S&P, and I have a few different views of this weekly chart. Here is another one, traders. This is another one of our proprietary moving averages. Look at this. It's extremely important. This average, if you get below it, it's a big run. If you get below it, it's a big run. Look right here. When you finally get above it, measure the size of this run before it breaks. Then you get below it, you get above. Look at the size of this run before it breaks. Then you get below it, now you're above. We are in what's to be a long run like this one and that one. This OMNI average is no joke. I do not show it to you all the time. It keeps me in check quite often of where these markets are going. This is due because that worked and this worked around this proprietary average. Next, the E-mini S&P, another weekly chart showing the crash lows. Up close now on this parallel channel, look at the hold of the 200 bar moving average, traders. It couldn't hold above here, big crash. It could not get above here, it crashed. Finally gets above. When it holds down here and gets back above, we have a test, it holds, and we're all the way up here now. That is a very, very strong looking E-mini S&P weekly bar chart. Let's continue. And by the way, traders, this high, if you do not think it will be taken out, let's see, this is a follower, don't forget. Let's go look at a leader. The follower is the E-mini S&P. The follower is expected to get up here. Why? Remember, E-mini S&P has an inverted head and shoulders, which is bullish, is in a parallel channel, which has expanded, and its target is up at the top of the channel. Why? Follower. Remember, follower. Here is the NASDAQ now. Is much more of a leader than is the S&P. The NASDAQ's our leader. It has gotten above those previous highs. The leader got above. I assure you the follower will. These were previous highs. The leader bested it. The follower has no choice. Again, look at our OMNI proprietary average. Look at the major rally that ensues, then we get back below the average, and a major rally ensues and we get back below the average. We are expecting a major rally in that NASDAQ. Traders, let's look at another NASDAQ now. This is the leader. It's a daily, just like that last E-mini S&P daily I showed you with the target up there. Why do I think E-mini gets there? Because the leader, NASDAQ, is almost there already. Look at this run, ba-bang, it's on its way. The follower, E-mini S&P, will absolutely follow. Traders, moving right along, we now go to the Russell 2000. This is a weekly bar chart where every one of these green lines represents 1 full week's worth of trading. Again, one of our OMNI proprietary averages. Look at the respect that the Russell pays to this average. After getting above, massive rally. Tests it, gets back above, massive rally. When it gets below, look at the drop. Now it's back above, massive rally expected. On top of that, this is a weekly. It's very important. This is major resistance right here on the weekly. A high, another high, connect them and draw out. We are now above that on our settlement Friday in the Russell 2000. Let's continue. Another Russell. This is the daily Russell. Look at the blowout breakout out of this wonderful parallel channel. And of course, we're well above the OMNI proprietary, or one of our OMNI proprietary averages. On the daily, it held it well, created the parallel bottom. Now look, we are up here, traders. We have blown out of that channel. We are on our way. Now we go around the world slightly. We go over to Europe and we look at the German DAX. This is the OMNI proprietary moving average. Look what happens when you get below that one. Well, bam, you get back to it. You get above, major rally. You get below, look at the spike. Gets above, can't handle it. Back down, gets here. Now we are above it, and we are here, traders, breaking out of major resistance. The German DAX on a weekly is starting to look great. And here are your several weeks to several months that they would be behind us, exactly as we thought. Here's your time lag. And traders, Europe is going to start to join the race as well. You'll see the time lag is almost over. The German DAX on a daily, you got above what was its stalling point last time. It crashed, right? It came all the way down. It tried to get up here, stalled, went back down below my average. Now has held the average and has gotten above those previous highs and has broken out of this parallel channel. The DAX is looking fantastic right here, traders. You gotta love US and German indices. Now, if the DAX is moving up, their currency should move up. Look at the bull flag on the Euro currency daily bar chart. Nice and strong bull-looking flag when it's trying to put in this nice V bottom, then puts in the bull flag. As we know, bull flags call for higher levels. If the German DAX looks like it wants to go higher and there is a bull flag in the Euro, I'll bet you they go up together. Traders, that would make sense. Why? Because look at the dollar index, the daily bar chart, steeped in this bearish channel. It doesn't look like you're going to get out of it anytime soon. And if it continues to go lower and fills in this channel, that will push the euro higher. It'll push the stock market higher. It will push the German DAX higher. Then this brings us to the federal government and bonds. Traders, if the market's getting better, if the U.S. economy is recovering, if the charts are really pointing us in the direction of a full-blown recovery starting to take hold, that means that the Fed is going to stop these bond purchases at some point. What I have always noticed is that when markets top out, they put in what's called a rounded top, whereas they hit the top of a rounded tool a few times and then start to fall off. The rounded top hits, look at the rounded bottom, how it catches all these bottoms right here. This is considered the possibility of a rounded top beginning, and then there's this. One of our OMNI proprietary moving averages works really well in bonds. It is this one. Holds bonds in check here, 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 and here. But now we're down here and we settled below this average as of Friday. And if that continues, we should head back down to this ring or this rung of the rounded top tool. We could have a nice little drop in bonds. And if the U.S. economy is really recovering, the Fed knows right away they're going to have to raise rates at some point, either this year or next, and that makes bonds really come off. Traders, this whole thing is about following economic indicators, right? That is what I want you to remember. That is what this is about. The charts are economic indicators. Do not forget the first chart that we looked at this evening. It is the copper daily bar chart. It is truly an economic indicator of activity, and it looks to me like activity is picking up. So, traders, you've seen the charts. There is my technical argument for why, both short and intermediate term, we have a green OMNI on the board. That green OMNI is for ES, for NASDAQ, for Russell, for DAX. Traders, let's go to the board. Indices looking quite bullish on charts. I think I just proved that to you. Did they look bullish on what?
Yeah.
Absolutely, right? The U.S. economy is growing just as technical analysis of the charts said it would. Now, figures are getting better. The charts are absolutely proving to be what they were supposed to be. Propulsion for the upside. The barometer I had put together several months back using Vegas as a barometer of the United States activity, of the economic activity, has proven to be correct. The real estate videos I showed you showing real estate picking up, and if it's happening here, it's happening everywhere. That is proving to be correct. Traders, what does that do for us? Well, that allows me to go back to a good old friend that I rely upon and I really enjoy when he's around me, traders. And you know who that friend is? It is my marker, it is this board, and it is the slogan, do not fall in love with the downside. Traders, it is back on my board. Congratulations, market. Do not fall in love with the downside. What does that mean for us Omniacs? That means this. From this week forward, we start backing off on any short setups and we just wait for the buy setups to take place. And we do not fall in love with any dips, because dips, people will come out of the woodwork and scream, told you it was going to come to an end, here comes the crash. You know what? Don't listen to these crazies. The charts tell us there is no crash coming. The charts tell us we are absolutely moving higher. Nothing goes straight up, traders. We all know that. A stop is your best friend. These markets, although they're bullish, they're not going to go straight up. They're going to go up and correct and up and correct and up and correct, because that's what a bull market does. These are the corrections that you need to react to. And on the way up, you do not want to try to sell this. That's when we no longer take the short trades. Do not fall in love with the downside. Now, that being said, I'm certainly going to have to take some of the short setups. If it looks like it's going to be more than a day or two, then we'll have to play it. The short setups that look like a one-day play will start backing off slowly as this year progresses, and we will remember to do not fall in love with any downside dips. Traders, I'm so happy that's back on my board. You have no idea. If you like the analysis that I've just put forth in this video, please come on down to my site. It's livewithoscar.com. Jump into my free trading rooms. The memberships are free for the open room. And do not trade alone. Don't trade alone, traders. It is so difficult to sit in your house looking at markets, looking at quotes, looking at charts, watching the news, people call you on the phone, and not knowing how to handle all of that information. You come on down to livewithoscar.com, come into my trading rooms. I am at the helm, keeping my Omniacs calm. I am there making sure that they understand technical analysis. I'm there to make sure that they put their stops in to the best of my ability, and I am there to show them what a professional trader acts like during each day. Traders, I hope to see you at the site. I hope you really enjoyed this weekend webinar, and I hope you learned to keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Yeah. Now, for the real deal, I got my giant blue on, baby. Let's go, Giants. Let's go, Giants. Giants win the Super Bowl this weekend. Thank you for tuning in. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.